happy September. Can you imagine? Here we are already in September, and it still feels like it should only maybe be May. But it is September, the winds have changed, the fires have started, and it's going to be quite a season. Anybody ready for 2020 to end? I think most of us are. All right, so I'm going to share with you tonight. I am your speaker. So there's a few of our normal things that we talk about. I did ask Liz if she wanted to share a market update, and quite honestly, not much in our marketplace has changed. The biggest thing that we're starting to see is an exodus from the city. So that would be important to pay attention to if you're investing. You know, if we look at nationwide trends, the cities like New York and San Francisco have all seen their peak, and people are leaving, and they're going out to areas like Truckee or Idaho, the Midwest, the Southeast, and being able to work remotely. And so I think that this is going to show us a shift of people moving around. So let me go ahead and get started. Welcome to SJREI. It's where the deals happen. And you can pretty much ask me anything in real estate. As you know, my background is I've been in the real estate for over 30 years, and I've done just about every kind of transaction. I currently specialize in Bay Area rehabs and development projects. So SJREI, we are here for education. We don't make any endorsements, warranties, or guarantees with any services, products, or promoted speakers, including myself. We ask that you do your own due diligence. And if you've attended any of my meetings, you know how I say it. I say, you know, if you're going to keep the gain, you get to keep the loss too. So we hope that you don't have a loss, but we do know that there is that chance. And even Warren Buffett says that if you're investing, you have to expect the loss. You just want more gains than losses. So our mission is to provide education, networking, and inspiration so that you can make a difference in your future and the future of those that you love. When we did a survey, we found out that over 78% of our regular attendees have done business together. And that's why we say it's where the deals happen. And quite honestly, every week, I get multiple deals in my email and desk, opportunities to participate, opportunities to send out to the database. And so I do encourage you to make sure that you're getting our emails, because in the near future, we're going to start sharing some of these deals with you. So I'm going to get started. Tonight, we're going to talk about private lending. And before we do, I want to start with a little bit of some history. As we all know, in January 1848, gold was found in John Sutter's mill. And he had asked the workers to be quiet because he knew that if the gold word got out, the prospectors would all show up. And he wasn't really even interested in the gold. He wanted to continue milling. But by the late 1848s, droves of people flooded into the state. But did you know that only 3 of every 1,000 got rich? So there was a lot of people chasing the gold, but not a lot that got rich. So who did get rich? The merchants, the food suppliers, the tool suppliers. And you know what? The merchants needed loans to buy their inventory. So even the private lenders got rich because they came to the rescue. They prospered with less risk than the merchants because they took the materials as collateral and loaned money to the merchants. And so tonight, that's what we're going to talk about, is how can you invest, participate in the market, and reduce your risk. So just to kind of talk a little high level here, there's a typical deal components. I have 4 of them listed here. You know, the idea of real estate is you have to find it, then you have to fund it. Sometimes you fix it or add value, and then you flip it. What we're talking about tonight is the funded part. How do you get it funded? And we're going to talk about it from another side, not so much about if you're an investor, how to go out and find money, but I know that there's quite a few people that are sitting on some money, they have some equity, and they're wondering how can they earn on that money to keep up with inflation. And so that's what we're talking about today, is how to be a private lender, how to be wise in being a private lender. Because really, the money is in the money. And that's a key piece to recognize. The money is in the money. So what's the number one fear that any new investor has when they're making an offer to a seller? The number one fear is the offer gets accepted. And you might think, really? Isn't that what they want? No, because most new investors are fearful. They're like, where do I get the money? How am I going to make this happen? But the truth of the matter is, if you find the deal, like a great deal, not just a good deal, a great deal, the money will come. It's like the field of dreams. If you plant it, they will come. And the money will come because money or capital is always out searching to find the asymmetric reward to risk ratios. And real estate is one of those areas that you can get that asymmetric reward to risk. But I'm going to tell you right now, ignorance in this field is not bliss. So I'm going to start basic with a little bit of a diagram here. We have our lender, which could be you, and you have some money that you want to loan. We have a borrower, and I want to point out here, the borrower has ownership of the house. They have a deed, and these deeds, we're going to see the word deed pop up a couple times, and I explain this just to make sure we understand the same vernacular here. Usually this is a warranty deed or grant deed. Sometimes it's a quit claim deed. But this deed that you see here is related to ownership. We bring to the table a title company, title or escrow, really it's escrow. And what they're doing is they're going to be the intermediary between the borrower and the lender. They're going to make sure everybody does what they're supposed to do. So here, the borrower executes 2 documents. And there's a lot of confusion about this. Sometimes people think that there's only one because they hear it as a mortgage, or they hear of a promissory note. Okay, so depending on where you're investing, you'll want to learn what it is. In the state of California, the 2 tools that you will use are called deed of trust. Again, deed is in the name. It's different than ownership deed. And a promissory note. So it's a deed of trust and a promissory note. Those get executed and escrow holds them. The money from the lender goes to escrow, and then escrow does some work. What they do is they make sure that the note physically goes to the lender, that the deed of trust gets recorded at the county recorder's office. Notice that the note is not getting recorded. The details of the note are private between the borrower and the lender. And then they give the borrower the money once it's been recorded at the recorder's office. This protects the lender. If you happen to loan money to somebody and you give them the money before your deed of trust gets recorded, you may not have a secure loan. So it's very important that you work with escrow or that you ensure that your deed of trust or mortgage, depending on where you're at, is recorded. That's the piece or the instrument, excuse me, that protects you. Now, I also want to talk a little bit about the difference between debt and equity and some of the terms that you're going to see in this, this presentation as I'm going through it. So the first thing is the black box, the outline of the house, is the value of the house. The value of the house might be that it's worth $1 million, okay? That's the value. Maybe you've borrowed money, you've taken a loan out, that's the red, that might be $500,000. If that's the case, then there's equity of $500,000. But equity isn't always earned. Sometimes it's you putting down payment money in. And people think that down payment isn't equity, but it really is. That's your equity too, right? So whatever isn't the loan and is the difference between the value of the house and what you have borrowed, that's your equity. Okay, so let's go through some terms. You'll see something called LTV, or loan, loan to value. That is, what portion of loan to the value do you have? Then you might see something that is called loan to purchase. That's what you're actually paying for the house. And if you're a good wholesale negotiator, you're going to pay less than the value of the house. So your loan to purchase is going to be less than the value of the house. So your loan to purchase might be 65%, even though your loan to value is 75%. I think I said that backwards, but anyway, you get the point. And then loan to cost. Let's say that you're going to add value, like you're going to rehab the property. If you're rehabbing the property, you're going to have costs in addition to the purchase. And so some lenders will do a loan to cost estimate. And then maybe you're really increasing the value. Maybe instead of one house, you're building two, or you're adding significant value to the house. Some lenders will loan on something called after repair value, okay? After repair, or ARV. As far as structuring loans, it is the Wild West. You can structure loans any way you want to. So what I've done is I've shared just some of the common things that you see out in the marketplace. The reason they're common is they've been tested for risk. So it's important to understand common usually means tested. It doesn't mean that you have to do these, okay? So usually there is a first mortgage or deed of trust. And that first mortgage or deed of trust is anywhere from 65 to 80% of the loan to value. And then usually there is either a second or even third, fourth, depending on the type of structure, that will take that up to 80 to 100%. Okay, now the first mortgage is going to have the least amount of risk. And so the first mortgage is going to have the lowest interest payment. The second mortgage is going to have more risk, and depending on how close to this 100% you get, the interest rate is going to go up. Another way to structure it is maybe a first mortgage or deed of trust that is 65 to 80%. And instead of there being a second mortgage, it's an equity partnership. So you're sharing in the equity. Usually when you share in the equity, you'll get a certain percent plus a profit share. Another way to structure the deals is, again, a first mortgage for the purchase plus 100% of the rehab money. But usually this 100% of the rehab money is capped to a certain percent of the after repair value. So you don't want to be loaning out 100% of the after repair value. You want to make sure that you're working to have some value left in the property. And lastly, whenever you're doing loans, especially as private lenders, and you're going on land, be very careful that you don't go too much higher than 65% of the purchase price. I'm not even talking value here, I'm talking purchase price, because land is usually the first to go down in a market and the last to go up in a market. So it's very difficult to resell land if you happen to get it back. So one of the questions that some people ask me is like, hey, I really want to be a private lender. I don't have enough, like maybe I only have 40,000. How do I become a private lender? I don't have enough to put into $1 million property in the Bay Area. That's fine, okay? So there's many creative ways to find the money. So you can borrow money from your 401k. If you've got an IRA self-directed, you can use that. If you've got some assets where you have home equity lines of credit, you can use that money. Some people even use credit cards. You can use friends, family, and relatives. That's what the FF&R is. And, you know, some of the people that I'm working with right now are actually selling their highly appreciated low basis assets. And they're deciding, instead of doing a 1031, they're going to do the installment sale program that I represent. Now, if you haven't heard of the installment sale program, high level is that you walk away from closing with cash that you don't have to pay taxes on for 30 years. Sounds pretty good, right? So they're thinking of cashing out of some of their California rental properties, because California has decided we are the enemy. And they are using that money in private lending. Okay, so I'm going to give you 3 rules to live or lend by. And these rules really should be, you know, lend or die by, okay? Rule number 1, always protect your principal. Okay. So the first thing you want to do is make sure that you start out small if you're not familiar with private lending. Starting out small, this is what we call your Las Vegas money, not your bread and butter money. So don't start, you know, loaning out money that you need back next month to pay your bills. Okay, start out small and be wise. And then be patient, because if you rush this process and you're quickly trying to get into a deal because you want to earn some money, or, you know, you choose a bad deal, you could end up losing your principal. So be patient. Don't be so quick to get into a deal. One of the quotes that I love from Warren Buffett is that wealth is transferred from the impatient to the patient. So the more that you can be patient and you can look at all of these deals, both short-term and long-term, you are going to see the wealth transferred to you. And I say this because we are going into times where maybe you decide to go out and be a private lender and the market changes. And instead of selling the property and getting your money back, you need to leave the money in the asset and let it ride through the recession. That is important, because you're not going to basically put your loss on paper. You're leaving it in the asset and it will most likely come back. You know, there's a theory that all bear markets are followed by bull markets, and then all bull markets are followed by bear markets. Or if you're into seasons, winter comes every year, but then it's followed by spring, by summer, and by fall. So you have to master your mind, or it will master you, knowing and understanding that whenever something goes down, it comes back up. It's a matter of time. That helps you to be in the patient side of the wealth building. So again, start out small, be patient, and most important, Get it in writing. I cannot tell you how many people reach out to me after they have sent money to somebody and never got the email that they were expecting to get with the signed documents. First of all, if you're not familiar with who you're working with, you should be using an escrow company. You should always get things done in writing, especially when you're sending money. Do you know what the law says if you send out money and you don't have a contract? The law says you just gave a gift. That sucks. Don't gift people, loan to them. Rule number 2, limit your downside. Okay. First, we're protecting what we have. Now we're limiting our downside. Good investors are always looking for that asymmetric reward. The asymmetric reward does not mean there isn't risk. It means that the risk is less than the possibility to win. So here is an example of how you can think about this. Let's assume you have $100,000 to start with, and you decide to loan it out privately at 12% with 2 points. Points is 1%. So 2 points just means that you're getting paid upfront on your money. And let's say you can do this for every 6 months. That means that you would earn $8,000 in 6 months, or it's about a 16% annualized return on investment. At 16%, that means it would take 4.5 years to double your money or to earn your money back. So you have to ask yourself, if you're investing this money, are you certain that, let's see, 9 times, that you can loan this money out 9 times and it will come back? Because you want it to come back at least what you're loaning it out. And so you have to look at that type of risk. What type of risk does the investment have? What is the likelihood that you will lose 100% of your investment? So that's the key piece here too for real estate, is if you have followed the process of securing it against your collateral, insuring the collateral, the chances of you losing 100%, if you are patient and wait for the market to cycle, is very, very low. And that's why people like to be private lenders. Okay, so then the other thing that you need to do to limit your risk, your downside, is you have to plan against your risks. Slow down and ask yourself, what is the market doing right now? What cycle of the market are we in? Are we in the fall? Are we going to be going into winter? What do you know about the geographical and demographics of the area? Are people leaving, like in San Francisco? Are people leaving because they don't have to be there anymore? What do you know about the partner? Are they ethical? Do they have integrity? Have they been through a downturn before, like 2008, and recovered? What do you know about the collateral? Has it been appraised? Has it been inspected? Is there, good knowledge that you have of the collateral? And lastly, what is the economy doing? Like right now, one of the uncertainties we have is the election. What happens if Biden wins? What happens if Trump wins? Understanding the economic cycles also is part of your risk. And we've heard this before. If you fail to plan, you plan to fail. So you have to think through each of those and come up with, what am I going to do if this happens? What am I going to do if that happens? And when you take the time to do that, you can sleep at night because you have peace of mind. You've planned. You can only control your actions. So a lot of people get anxious about doing this. They're worried about all the things that are outside of their control. You can't control it. It's outside of your control. So it's really important to focus on what you can control and to put together an action plan to mitigate those risks. And I see that some people are entering questions. Please keep entering the questions, and when we get to the end, I'll go through all of those, okay? Also, the other thing to realize is that leaders anticipate, losers react. So plan ahead, anticipate what might happen, and that way you're not following the trend and reacting. Okay, rule number 3, seek battle-worn advice. Okay, I don't know if battle-worn's really a word or not, but it's seek advice from somebody who's been through similar situations that we're in right now. You know, did the person that you're loaning money to go through 2008? How did they handle it? Has the person ever lost everything? How did they handle it? You know, find people who have been to battle. And it's okay if they've been to battle and they've lost the arm and a leg. I mean, picture a general, you know, a general that's battle worn, you know, he's got no arm and a patch on his eye and, you know, a limp on his leg, but he still knows the plays to get his troops in and out of battle. That's what you're looking for when I say seek battle-worn advice. So third-party advice, when you're doing private lending, you want to make sure that you have an attorney that is reviewing your documentation in the beginning. Once you get a template that you're familiar with, that's great, but you've got to have that attorney review it. You should be talking to your CPA, making sure you understand the ramifications of the income, because most of the income that comes on loaning is ordinary income. And you can plan ways to shelter that, but you do need to understand that. Talk to other investors. Find out what they're investing in. Find out what their criteria for making decisions are. And of course, I always say have a mentor or coach. Be working closely with a mentor or coach on what it is that you're planning to do to make sure, 1, it fits your goals, and 2, it fits your risk tolerance. Now, find divergent viewpoints. This is an interesting one. We like to hang with people who think like us. You know, birds of a feather flock together, right? And we might say to somebody, hey, I got this great idea. What do you think? But we're sharing it already knowing they think like us, and they really aren't going to challenge us too much. And we do it for confirmation bias, really. We're trying to find all the stuff around to verify that what we're thinking is right. In no better way that I can say this, it's better to have somebody tell you you're being a fool than to be the fool. So go out and find divergent viewpoints. Ask people, why do you think this is a bad investment? Why would you not do this? Tell me all your reasons, and seek to understand, not to be right. Because once you start to understand, then you can say, okay, I understand why somebody would not make this investment, but I'm still okay making this investment and I'm going to move forward. Or now I understand why they're not making this investment and I'm not going to go through that. Okay, so it's really important to seek out people who have different viewpoints than you. So if you've been following me at any amount of time, you know one of my famous quotes is that you will always pay for your education one way or another, either by borrowing somebody else's knowledge or walking through it on your own. The wisdom comes in knowing that the first process is less painful, okay? So people will make investments and they will lose investments, and they learn, unfortunately, the hard way. It's just kind of like touching the stove. We as parents will say to our kids, don't touch it, it's hot. And some of the kids will listen and some of them will touch it. And then we say, see, told you. So that's why I say seek out battle-worn advice, okay? Don't go to a newbie and say, what do you think? You know, go to somebody who's been through turbulent times and ask. So to recap, the 3 rules are always protect your principal, limit your downside, and seek battle-worn advice. Okay. Sorry. Okay, so now I'm going to tell you the 5 common gotchas that I hear about as the leader of SJREI. Wow, that was backwards. Okay, number 1. People have a tendency to be too greedy. So they will loan money to somebody who's promising them 20%, but they're loaning the money typically on something that has no collateral or very little collateral, such as they're giving 125% of the value. And whenever something sounds too good to be true, it is. Okay. Unfortunately, a lot of people are too busy to dot the I's and cross the T's. And so they don't wait until they get the paperwork in writing. They send the money and they're waiting for the paperwork to come in and it doesn't come in, okay? Don't be too busy, because too busy is not too good. These really ended up out of whack. Let me just pull all the up here. There we go. Don't be penny wise and pound foolish. Okay. What I mean by this is some people will go out to the internet, they'll search up a document, they'll use that document as a lender's document because they want to save the money rather than paying $500 for an attorney to review it. And then something goes wrong and you have to go ahead and hire an attorney to fight to get your money back. And when you do, you find out that the document that you used is not going to allow you to get your money back. That would be penny wise, pound foolish. An example of this might be running with what you hear other people charging, such as a lot of people will charge 12% plus 2 points in the hard money. But actually in the state of California, that is usury. And what that means is that you cannot collect in a foreclosure if your note is written to usury. So the lender can only be paid 10% annualized. That includes points and that if you're going into foreclosure. So you may have to redo some documents. I don't want to open Pandora's box, but what I'm telling you is make sure to pay for the appropriate legal advice if you're going to do this. Don't be too impatient. You know, people are so anxious to get into a deal that they make poor decisions. They move forward quickly because they think all of a sudden, hey, I'm going to put this money here and I'm going to get money back and it's going to be great. And they don't do proper due diligence. So don't be too impatient. And the last one I have here is people think like, or you think people think like you do. So you might hear somebody say, I jumped the river, but you're thinking they jumped in the river when they said, I jumped the river. Okay, we don't always hear everything. We don't think the same way. And it's important to understand that not everybody thinks the same way as you. That's why we put stuff on paper. That's why we have other parties read it. That's why we ask for divergent opinions and advice, because everybody hears and understands things just slightly different. So people do not think like you do. And when you start thinking they do, you are going to have misunderstandings. And misunderstandings usually lead to disappointment. So, okay. So I'm going to remind you here, that we have a lot of deals. We have stuff that's coming to us all the time. And in reminding you that, I just want you to know that if you are thinking of doing private lending, you can reach out to me and get some advice. If you need a deal to invest in, I'm going to show you just a couple that we're doing, but like I said, I have deals coming all the time, and we can take amounts as little as $50,000. Typically, most of our investors are $150,000 to $250,000. So here's an example of a deal. One of my coaching students, Joshua, found this deal. First of all, I just want to tell you, I love it when people are action takers and they go out and just do it. So anyway, new wholesaler, just got out there, marketing, met with the seller, tied up a piece of property, brought it to me. I decided that I would go ahead and rehab the property, but his numbers were a little bit too rich. Like, he had offered too much money to the seller. So I worked with him, got some scripts together, told him how to go back and negotiate a price that was appropriate for him and for me, and to ask the seller if they would finance us. They did, no problem. So here we have this, isn't it beautiful, this beautiful house in Cupertino, seller financed, very little risk, low interest rate, for $1.9 million. It needs about $200,000 for repairs, and it will sell for $2.6 million pretty easily. And so we are looking for anybody who might want to be involved in this project for the $200,000. In addition, we have a commercial property, and this commercial property will move into development. We have this property and the property right next door. We will be building about 40, probably 2-bedroom, 1-bedroom mix apartments with mixed use on the main floor. The first step is to get the restaurant transferred to a restaurant owner that we're working with, and that will continue to run for the 2 to 3 years that it takes us to go through development. So again, talking with the seller, we were able to secure seller financing, and we're looking at $250,000 for the down payment, closing costs, and some carry costs. And this side of it, it's going to be combined with another one. This side alone will sell for about $2 million pretty easily. So these are some of the deals. And I just want to tell you, if you're out negotiating deals, right now is a great time to be talking to sellers about seller financing, because they understand that when they get the money in their hand, they're not going to be able to get a good return on it. And so by having the asset they already understand as their collateral, you can turn the sellers into private lenders and not have to go out and get hard money. Okay, so if you want to have a consult with me about any of your deals, about being a private lender, if you want to invest in any of our deals, we have a lot more. That was just showing you a couple examples. You can get a hold of me on my calendar. You just go out to www.callwithlori.com and book a time, free consult, no problem there. And I'll work with you to see how we can make you successful. So if you've got questions, now's the time. And I am going to pull this over so I can read them. And let's see here. And this is being recorded, so it will be available for playback. Okay, so I did a private loan where a borrower postponed foreclosure sale for over a year successfully, incurring large legal bills. Other than protective equity, any other tools to weed out bad borrowers? Okay, so the state of California can make it very difficult to foreclose. First of all, if you're private lending, you should not private lend on a primary residence, because that's even worse. So it should be a business loan that is done on a piece of property that is not a primary residence. Typically, you are allowed to recover your legal bills. I would suggest that if you're working with somebody and you have a good relationship with them, that you discuss the divorce before the honeymoon. What I mean by that is you have them sign a deed in lieu of foreclosure to leave with escrow, so that if they don't make payment, that can get filed and you don't have to go through foreclosure. Not everybody is going to do that. So the only other thing is cross-collateralize other properties. And of course, you know, you do want to get personal guarantees from people, because if they have an entity and then they let that entity go into bankruptcy and the property gets sold, you want to make sure you have an opportunity to still get paid. And so that would be a personal guarantee. Good question. Okay, do you have a template to lend out money that you could share? I don't have a template. Every deal I analyze, I look at what the risk to reward is. So it really comes down to, you know, what am I comfortable with? Do I know the person? Do I know the market? Do I feel comfortable, you know, if I was to get the property and getting my money back out? I don't have a template. The only thing I can suggest is, you know, just watch your loan to value and your loan to after repair values. Okay, as far as great advice about battle worn, how would you know if a borrower is lying? You don't, unless you do a background or credit report or the like. Yeah, no, unfortunately, I've had situations with that too, where I was in a second position and thought that I was going to be safe in a second position and was not. So yeah. Are commercial properties safer to lend to? I'm not sure if I understand commercial. So business is easier than personal. So if it's a, if the person does not live there as their primary residence, you will have a better time foreclosing than if it is a personal residence. Now, if you loan on a personal I'm sorry, let me say that again. If you loan on a house will have more buyers, so you'll get your money back faster. If you loan on a commercial property, that could stay vacant, or it could take a long time to find a buyer after you have foreclosed on it to get your money out. So I don't know that commercial is the right word, but you just want to make sure that you're not loaning to people in their primary residence. That's the key piece. Okay, how and where to find mentor coaches and the right one. So here's the thing. Go to REIAs like this one, other ones, meetups, and talk to people and find somebody that you connect with. You know, I do mentoring, but I'm not the only one in the marketplace. There's a lot of people out there. So just kind of search Facebook, go out to LinkedIn, go out to meetup.com and see who is doing mentorship and coaching. Okay. Any recommendations on attorneys who will review loan docs for $500? Yeah, so what I'll do is I have got a short list. If you email me, I will send you the short list. I don't want to just kind of like put it out here because I didn't ask permission to share their information, but definitely I can share that. Yes, and the 10% cap is apply to non-licensed brokers. I should tell you that part. But here's the thing. If you're a private lender and you don't run your loan through a broker, you're capped at 10% for usury. So it is important to make sure that you either go through a broker that is licensed or you cap it at 10%. Okay, is it possible to lend to people in other states outside of California? Yes, you can lend to anybody. I have many years of experience working in Georgia and Alabama, Florida, and we have made loans outside of all those areas. So Maggie has asked, is there sort of a private lending 101 book, seminar, or something? You know what I would recommend is going out to Bigger Pockets. And on Bigger Pockets, just type in private lending. There's all kinds of podcasts that you can listen to out there. That's probably where I'd recommend starting. Okay, how about a self-directed IRA company? So I like UDirect with Karin Hall, and that information, Jeff, is that information up on our website yet for Karin?
It is. I think it is. If it's not, I'll get it up there.
Okay. Yeah, so you should be able to go out there. I like UDirect. The other one that I've had experience with, but I think they changed their name, was IRA Services, but I'll have to look and see what they're called now because they got bought out. And I don't know, what their fee structures are anymore. Okay. What kind of return is the market rate right now? So talking on private loans, my seller finance loans, I'm getting first positions at 5%. My second mortgage loans are between 8 and 10%, depending on the LTVs, which is pretty high considering how low interest rates and all of that is, but that's pretty much where we're at right now. CPA to help shelter ordinary income. I highly recommend working with Anderson Advisors. And the reason I say Anderson is where I go, one, they understand all the components of investing. There's the legal side, there's the tax side, there's the actually doing business side, and they understand all of those when they put a plan together, so that it's not just I'm going to shelter this piece, but then all of a sudden I exposed myself over here. They understand the whole picture and create a picture for you. So definitely Anderson. Again, we should have all the resources on our website that you can go out there and get their contact info. Okay. Should you lend to a first-time flipper, and how to structure the deal? Wow, that's loaded. Okay, if the first-time flipper has a way to secure you beyond the original deal, maybe. First-time flipper is working with a mentor, maybe. If you are highly experienced in flipping and feel good about this person's experience as far as knowledge of what they're going to do, even though this might be their first flip, maybe. I can't say yes or no. I would say you have to do your due diligence and you have to mitigate your risk. Yeah, everybody's first somewhere, right? I like to see first-time flippers work with a mentor on their first deal and then move forward. Now, how to structure the deal. Typically, if you have done flipping before and now you just want to loan the money, you're going to be involved in some of the management of it. You're going to visit a lot. I would say it's probably more like a JV where you know, the loan is taken out by the flipper, you bring in the equity piece of it and you get a share of the profit. Whether it's 50-50 or not, that's all up for negotiations. Okay, so as far as attorneys, it really depends on what kind of attorney you're looking for. If it's a business entity attorney, Anderson Advisors. If it's somebody who's going to review your contracts and that side, it's going to be somebody different. If it's litigation, it's somebody different. So if you have a specific need for an attorney, I'd like you to email me, Lori@sjrei.org, and I'll make an introduction to the appropriate attorney. What is the typical LTV ratio when you lend? Okay, when I lend, I typically do seconds, and I will create it sort of like a HELOC. I'll create the note for the full amount, but then I give out portions as the money is used against the property. So that's usually how we do ours. What do you mean we need to use a broker to lend money? Well, you don't need to use a broker. You can lend money to anybody you want to lend money to, pretty much at any rate you want to lend it. But if you lend at a rate more than 10% and you are not licensed and you do more than 3, you could run into problems. So it's recommended that you find a lender, like a broker. Go to somebody who's licensed as a real estate broker. As a mortgage broker, and have them prepare your note and your deed of trust. You usually have to pay them maybe, you know, I don't know, $1,000 or something like that. And they will take care of it. You can charge any amount of interest that you want to charge. Okay. And, you know, again, some of the stuff you learn the hard way. There's a lot of rules in what is considered prepared by a broker versus not prepared by a broker. And you might assume that just by having them prepare the paperwork that it is prepared by a broker, but it is not. They need to actually set up escrow. They need to be compensated on the settlement statement, and then you can prove that it was prepared by a broker. That allows you to charge rates greater than 10%. 10% is what you can charge. Otherwise, it's considered usury if it's over and it's not through a broker. All right. Okay, so let's talk about some of my seller finance deals. When a seller finances, they actually get first position, just like the bank, right? So any money that's borrowed after that would be in a second position. And I know it looks like Nancy was asking, would a lender be in first position? No, they'd be in second position. The first position is the seller financing. We do that. And then the second position would be anybody who brings in. And my email is Lori, Lori, at SJREI.org. Okay. Okay. What is the typical time frame for private lending deals? It's all over the board. Depending on the type of project, private lending can be anywhere from 2 to 3 months to 2 to 3 years. Okay. And are there any more questions? Yeah, there's some private questions that were sent to me. I'll email to you answers on some of that information. Any more questions? Okay, again, if you have some deals you want to review, or you want to go into private lending and you're looking at what is my next step, or you're looking for some help, just head out to callwithlori.com, get on my calendar, and we'll have a conversation. Okay. I think that's it. I want to thank everybody. Oh, wait, we've got a couple more. Okay, it was too fast there. All right, what's a safe loan to value in today's market? Okay, it really depends where we're referring to. Today's market in regards to which geographical market. If we're talking San Francisco, 65%. If we're talking Santa Clara, maybe 80%. But again, the type of house, the type of investment, all that really matters. So I just really encourage you to look at the collateral, to test yourself. You know, are you going to be able to sleep at night if you make the loan? If it's going to cause you any sleep deprivation, don't do it, because peace of mind is worth more than money ever. Let's see, is there a way to do a 1031 exchange with the target being a private loan, getting out of the toilets and trash? Well, okay, so we have a program that's better than 1031s. What it's called is a monetized installment sale. If you book an appointment with me, I can go through the process, but essentially we swap your sales proceeds with non-taxable cash. So you have non-taxable cash that comes to you. You can use it for 30 years and it does not have to be taxed. At the end of 30 years, then you pay the taxes. So yeah, it's better than 1031 because you get to use the money. Yeah. So somebody says, I heard MIS is being challenged in the court. No. So what is being challenged is they are trying to get access to all of the clients' list of a couple of the people that are doing this, but there's no challenge in the court. It has been approved by Congress and the IRS in 2012. They wrote a memorandum in support of it. The IRS actually has audited several files. They all pass. And in 1980, Congress basically said you can receive loan proceeds in connection with tax deferral and still get tax deferral. So it stands up. It's defendable. So there's no issues. Now, the state of California has issued a franchise tax board minute or notes saying that you cannot use MIS to save a 1031. And that's true. You cannot. You can't save a 1031. If a failed 1031 is failed, it's failed. Nothing's going to save it. And we don't use the monetized installment sale to save a 1031. We use it instead of a 1031. And it's just a simple premise. If you go out to tax code, it's been there since 1913. The premise is that you only pay taxes on the sales proceeds you receive. If you're not receiving sales proceeds, you don't pay taxes on it. And so we structure it appropriately. So, all right. How do you do a background check on a borrower? Well, just like the bank does, you have them fill out an application or give you financial statements and permission to pull the credit. If you don't want to pull a credit, you ask them to pull a credit report and give it to you. So that's how I would do that. These are awesome questions. Thank you. All right, everyone. I want to wish you a great night. Stay safe. Hopefully the fires don't keep mucking up our skies here. And I will see you next month. We have Erin Norris. It's going to be awesome. I can't wait. So take care and look forward to talking to you soon. Bye-bye, everyone.